Good day, fellow investors. Warren Buffett has been piling up cash as he did before the 2007-2009 financial crisis. This is indicative of something. He says he can't predict markets, but he did it well here and he's doing it again here. The news is that over the last 2 years, Berkshire has sold 132 billion more in stocks than they have purchased. And Warren Buffett says that market timing is both impossible and stupid, but okay, he might not be timing the market, but he is certainly preparing for something as he did in the past. What does it mean for us investors? Let's see at the market and the opportunities from a value investing perspective, which is what we do on this channel. The first and foremost perspective I want to give you is the current S&P 500 price to earnings ratio that has spiked up in exuberance, and it is 30 compared to half of the historical average. If we go back to the historical average, there is plenty of room. And the markets also sometimes tend to overshoot on the downside in panic, and that could be a big issue, especially if interest rates stay higher for longer. Interest rates move in a cycle. Now there was commotion, the Fed lowered rates, then it will it be as planned? That could be the game changer for also market valuations. Bonds, this is the last news, rethink their rates and the projections. The bond yields also went down when the Fed cut, but are now back to previous levels, saying that we might not see the cuts that everyone expected, which then again impacts also valuation and everything else. If we compare interest rates and valuations, this is the S&P 500 ratio that has been growing for the last 40-something years. So valuations went from 7, yes, P ratio of 7, to the current 30. And if we want to smoothen those ups and downs recessions, we take the 10-year average earnings P ratio. And you can see here again from the 1980s has been nothing but growing in line with interest rates that have been nothing but declining since 2020. And interest rates have risen, but valuations have not gone down on the expectation that interest rates will decline and will stabilize at 2% to 3% for the longer term. However, if interest rates don't stabilize and we are in an upward interest rate cycle, you know what happens to valuations. Valuations go down, and that might be the key risk for investors, and also something that Warren Buffett might be watching. He says not to predict, but always look at what he does, not what he says. We have looked at food prices in this video, and if food prices go up and food prices have not been adding to inflation as there has been a downturn, but those did in the past, then we can immediately see higher inflation, and that's just one of the factors out there. Then we see here unemployment really good, so if you lower interest rates, you might spike up inflation even more. However, there is also this conundrum: the global debt levels, the burdens that cannot simply be sustained with higher interest rates. The whole deficit of the US budget should be going to net interest payments if interest rates stay at 5% for longer. That would really put things into trouble, and therefore maybe Buffett is saying nobody's going to give money to the US if they lower interest rates because this debt to GDP situations are unsustainable, especially if there is a recession or something. And therefore, Buffett might be thinking that there is a possibility that interest rates don't go lower, that we are in an upward interest rate cycle for longer. And if that happens, and if the lower interest rates expectations are not met, valuations must decrease. And if we have valuations going just back to normal or staying at 5%, then the average P ratio for the S&P 500 historical perspective should be 15, and that means a 50% crash for stocks, and that means Warren Buffett will be buying again. Yes, timing the market is impossible. His cash peaked in 2005, 3 years before the crisis. But what we can do, and we must do as value investors, watch the fundamentals, watch the price we pay in relation to the fundamentals, the earnings we are getting. And Warren Buffett is watching. He says, I will not pay P ratio 30, 1.5% dividend yield for the market, too expensive. I'm happier with short-term treasuries that give me 4-5%. Of course, that is because of his size. He cannot just go around the world and spend his hundreds of billions. He has to wait for that market cycle to revert, to buy big. But we as smaller investors, we can look globally for opportunities. We discussed Europe this week, Austria, etc., etc. Warren Buffett will not buy a billion-dollar company in Austria. So there are already opportunities out there, and we can prepare for what it looks like eventually will come, because sooner or later the interest rate cycle will revert. Thanks for watching, and I'll see you in the next video.